In this video, we'll talk about everything money and the myth of their 14, 16, 18 PE assumptions to all stocks. Crazy. Let me say this first, every investor has their own little way of approaching stocks. No way I'm saying their process is wrong. No one can say that, but what I can do is confirm their approach to my approach, their style to my style. I love the team. I watch them religiously. I love that they're teaching a process on how to approach stocks to young and new investors. I still think their software is worth your money, and I'm not paid to even say that. I guess what I'm trying to do here is stepping up and kind of reject this method of assumptions because you will miss out on a lot of opportunities. I am a PE guy. My three metrics are pretty heavy on the PE. I will tell you why Visa is not overvalued like everything money claims, and that their assumption of low PE for Visa is crazy. I will explain my case. There's this problem about the whole projection thing and them assigning 14, 16, 18 PE to almost all stocks. Let me put this to context. In their recent video, they assigned these PEs to Visa, 14, 16, 18 PE. This video is uploaded in March 19, 2022. While they assigned high profit margins and high free cash flows of high 40s. Let's pull up HPQ. They assigned 12, 13, 14 PEs to HPQ, just around those PEs, while assigning low profit margins and free cash flow margins of less than 7%. This video was uploaded in November 23, 2021. If we put this side by side, clearly these are two different companies, one making a very high yield and the other a very low one. You can't do this. You can't assign the same PEs to all stocks. The only reason why you got into Facebook with those assumptions is the risk of the stock. FB is an active user-based company. If people decided to stop using the app, their revenues will be hit and everything in their financials will look That is the only explanation I have why you were able to enter the stock at a low PE. Until Facebook becomes as solid as Apple's business model, it will always have these cycles of plunging down. If we look back and look closely at their stock analyzer, what these metrics compute is the future net income, ergo, the future EPS. And this is not even covering if the shares outstanding will be diluted or not. From this, I would say the whole stock analyzer is flawed and does not really tell anything about the future EPS. Either that or the assumptions they're inputting are wrong. The stock price is PE multiplied by the EPS. If you assigned low PEs, you will get a low price, no matter how high your assumptions in the revenue and the margins you put in the analyzer. Visa is not overvalued. In fact, it is trading at a discount. My second metric, if you watch my videos, we want to pay $1 or less for 1% of the money they're making. Meaning, we want to pay 1 PE or less for 1% of their margins. What you see here is revenues deconstructed. You'll see here the cost and expenses the company uses to make those revenues. Net income here is after tax already, and the free cash flow they generate off of those revenues. The above values are in billions, below are in respective percentages of their revenues, or as they call it, yields or margins. I'll show you the relationship of the sales. This metric tells us whether the stock is trading at overvalued, fair, or discounted prices. Of the four highlighted values, we'll use the lowest margin to divide our current PE. We'll use 47.97. Take note that 36.49 because I used that to be the basis of my PE assumptions. The PE I used here is 36.3. This is Yahoo Finance's PE because if you Google Visa, their PE is misleading and wrong at 43.53 because they use a wrong EPS. You'd see here Visa is trading at discounted prices. Now, of course, as value investors, we want a margin of safety. That's why I use 36.49 here in my assumptions. Now, if we use everything money's PE of 14, 16, 18, that is 2/3 of their yields off as their margin of safety. If we're looking at 1 PE is to 1% of their margins. Look at these prices. This is using the current or EPS trailing 12 months. Of course, you'll get a low price. That's what I'm saying. No matter how high your assumptions in the revenues and margins, if you use a low PE, the entry prices you'll get is low. Now, is this 32, 34, 36 PE still too high for your margin of safety? I bought the stock at $199. Am I being biased? I don't think I am. I'm not saying the price won't go down. I mean, we have a war in Ukraine and that will affect everything, the markets. But Visa, by these numbers, is not overvalued. Now, for context, we'll go to HPQ. Here's a quick look at my second metric. It's clear that we should pay low single-digit PE for this stock. But everything money's assumption, they use 12, 13, 14. Of course, this stock is always a buy because you assigned a PE 2 times their yields. You get the point? You can't assign the same PEs for low profit margin, high profit margin stocks. You can't use the same 14, 16, 18 PEs to all stocks. You'll miss out on a lot of things, a lot of opportunities. From these assumptions, you'll only get to own low profit margin companies, and not the kinds of high-tech stocks like Apple, Microsoft. Their assumptions are way conservative. That it's wrong. You'll only get those PEs when dire things happen, like COVID pandemic, war like in Ukraine, a massive bear market where EPS would catch up to their PEs, right? The myth of 14, 16, 18 PEs to all stock is not applicable to all stock. It shouldn't be applicable to all stocks, especially to Visa. That's my case. I still love them. I'd still watch them religiously. They just have to adjust their assumptions for different stocks.